So going into this week, there were probably three main macro factors that markets were looking at. The first was the fiscal stimulus out of Japan. We had a further announcement with a bit more detail on that this week. Then we had the Bank of England's Monetary Policy Committee meeting this week and subsequent monetary policy decisions that have come out of that, and the publication of the latest inflation report. And then this afternoon we have the US employment data out of the US. So that's going to be another focus for the markets. Just turning to Japan, you may remember that last Friday we had a bit of disappointment on the monetary policy front from the Bank of Japan, where the easing that came from that meeting was slightly more modest than had been anticipated. So there was a lot of focus on the fiscal package announced this week, and although this has left the market slightly underwhelmed, although the overall total package of 28 trillion is not inconsiderable, I think the markets were more concerned about the fact that there was a less than hope for near-term boost to growth. The fact that only about 4.6 trillion of that package is due to fall within the current year. There's also a sense that the Bank of Japan has also already done almost as much as it can outside of something like helicopter money, which has been mentioned previously. And that maybe at the review that they're going to be conducting in September of this year, there may be less scope for more accommodation on the monetary front. And this has had an impact on some of the asset classes. We've seen the yen appreciate. We've seen Japanese equities sell off, and probably most notably, we've seen a sharp reversal in yields in the Japanese bond market. Here we've got the 10-year Japanese government bond, which is still negative yielding, a negative rate, but it has bounced quite significantly off its lows. And this is perhaps a reminder of how quickly markets can move and adjust when we do have extremes in valuation. Moving on to what is probably the main event of the week, and that was the Bank of England's monetary policy decision. You remember they chose not to act in July because they had insufficient data post-Brexit. Well, there's still been very little in terms of hard data, but there's been enough in survey data for the bank to act, and in fact to act beyond what the market had expected. We've seen surveys of services, manufacturing, and the construction industry all indicating contraction in activity. And we've seen consumer and business sentiment indicators also deteriorate. And so this has seen the Bank of England cut the base rate by 25 basis points to 0.25%, which is the lowest it's ever been. This was a unanimous decision by the Monetary Policy Committee, but they've gone much further than anticipated. They haven't waited to the autumn statement to see what's going to come forward in terms of fiscal stimulus, but they've chosen to restart the quantitative easing program. So they're going to be buying government bonds, gilts, up to the tune of about £60 billion over a 6-month period. They've also introduced a buying program for non-financial investment grade corporate bonds, which have been an issue for over a month. So this is something which wasn't anticipated by the markets. And another interesting development is that they have introduced a term funding scheme for banks, so which effectively means that the banks can borrow at close to the base rate and then pass that on to the consumer. So it's trying to ensure that the transmission of the rate cut it feeds into the real economy, into households, into businesses. So all of this stimulus comes on the back of a downgrade in growth forecasts, including a cut to the 27 forecast from about 2.3% to 2.8%. And so it's a significant cut in growth over that period compared to pre-Brexit and post-Brexit. And they've also raised the inflation forecast to about 2.4% during the forecast period, which is above the 2% inflation target. But it seems that they're going to be prepared to look through the near-term increase in inflation in order to stimulate growth. So all these measures, they help to improve the supply of credit, but ultimately the effectiveness is all going to depend on how much demand there is for this increased supply of credit. The bank has also indicated that there is scope for further action in terms of further monetary easing within the existing framework, but so far they've ruled out a move to negative interest rates and also no helicopter money at this stage. In terms of the market reaction, we saw a sharp downgrade, a sharp fall off in yields across the government bond curve. Here we see the UK 5-year gilt significantly lower than it was and at a record low. In terms of the exchange rate, sterling fell off after the announcement. It's still not at the lowest levels it's been post-Brexit, but you can see intraday that it did fall quite significantly. And in terms of the FTSE, we've seen that rebound quite significantly. Clearly, a lot of the constituents in the FTSE 100 benefit from having a lower exchange rate because a lot of their earnings are foreign-based. Moving to the third macro event of the week, which is in focus for investors. This is the employment report out of the US this afternoon. This is important for a couple of reasons. Firstly, a lot of the economic data that's come out of the US recently has been inconclusive in terms of painting a picture of the outlook for the US economy. And secondly, if we look at the GDP number that came out for the second quarter in the US, it showed that the miss was quite substantial. It only came in at 1.2% compared to a 2.5% quarter-on-quarter annualized expectation. And a lot of the growth that we did see come through was due to the consumer. And so the consumer obviously is an important part of the US economy, and in order to have this consumption, we need to have a confident consumer, and we also need to have a good labour market, a strong labour market for this. In terms of the recent data we've had in terms of non-farm payrolls figures, we had a very weak report in May, which only showed 11,000 jobs added, and then we had a strong rebound in June, showing 287,000. So for July, we're expecting to see a figure of around 180,000 announced this afternoon. In terms of the week ahead, it's a slower reporting on the corporate front, slightly slower now than it has been in previous weeks. For us, the most important focus will be on Walt Disney and Solar City on Tuesday. On Wednesday, we've got Prudential and Michael Kors. Thursday, we've got Cineworld and Deutsche Telekom. Thank you very much.